Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. And we're actually going to start with a quarterly recap of the metals markets before we look at the weekly. So, Tori, what you got for me?
It's been a great quarter. Let's just start with gold and sort of go in order here. Looking range-wise, we opened the year at right around 1,800. We ended up dipping a little bit at 1,788. But think about seeing 1,788 for a low and 2,071 for the high. And just from the open to the close of the quarter, from the open of 2022 to the 31st of March, was an 8.1% uptick in the gold price.
Yeah, that's nothing to scoff at, and that doesn't even account for the high point. You're talking about where we ended up closing on the reversal.
Closing at the 1948.62, so 1,948 ended up putting gold up 8.1% for the quarter.
Going back to the beginning of the year, that's when we started to see gold kind of moving from below the 200-day moving average to above, and then we've had a significant push upwards and are currently sitting, despite the decline we've had in gold since the beginning of March, we're currently sitting quite a bit above the 200-day moving average. Now, over the last week, gold has kind of flatlined around that 382 fib. We got down to the 50% line, and we're kind of sitting just below the 382 fib. I would argue that you could still see a little bit more downwards pressure here on gold. I would put a low-end target maybe in the 1850s, 1860s. If we did see something break below 1900, that would put us at the 618 fib, and that would put us right around the November highs. We seem to continue to talk about November on the show. That seems somewhat significant and get us closer, probably even touching the 200-day moving average by the time it got down there. So that is still a possibility for those of you that are sitting with cash on the sidelines. You've already got a solid gold position. Now you're just looking to maybe dollar cost in over time. That would be a target I'd be looking for. Now on the upside, we don't have to go too much higher to look at potential breakouts. Really anything above the March high around 1965, I would argue you're looking at breakout territory, and we're probably on our way up to test the old highs.
All right, may it be. Let's jump over to silver. From a quarterly recap standpoint, opened the year at 2291. We closed the quarter at 2508. That's great. I mean, that's a 9.4% swing. Again, it didn't tell the whole story because we had a high of 2617 on the midpoint of the quarter and a low of 2224. So that's quite the range, but all said and done, from open of the year to the close of the quarter, silver up 9.4%.
Significant range in silver, not surprising, much more volatile metal. The highs are higher, 9% gain overall. And then, of course, the declines are higher, as well as silver has been falling down since the high in March, where gold was sitting around the 382 fib, silver sitting just below the 50% line, and actually did touch at 618. Silver and gold both look very similar. The difference is where gold is kind of flatlined, silver is sort of trailing downwards slightly. So it is possible we could see it inch back down further. I would argue a support on the bottom end for silver around 2396. That's your 618 fib. We hit at the end of March. And then upside, of course, would be the March high around 2584.
All right, moving over to platinum. Platinum, we opened the year at $958.54, so it had come down below that $1,000 mark, and we saw quite a rally again in the middle of the quarter, getting as high as 1,151. All said and done, we came back down towards the close of the quarter to 996.35, but that's still finishing up 4%. So we'll take that. Again, if we extrapolate these out over the course of the whole year, that would be on pace to exceed 16% for the entire year. But don't expect that to go unchecked. But tell us here about what's going on this week.
Yeah, platinum, I've got to throw all of last week's charts out the window. I was looking for some channel trading and upwards momentum, a turn in platinum up, which actually didn't end up happening. We got a breakdown below the potential channel we were looking at. Now, we're still at a higher low on platinum, but it's pushing down towards your more long-term 786 fib, which is a very deep correction, and could continue down from there. I don't see it likely with what's happening in Russia and with the understanding that a large percentage of the world's platinum supply does come out of Russia, and sanctions is going to make a big dent into the availability.
Agreed.
So we are looking at the availability of existing stock of platinum for industrial usage, and that could dry up very quickly. Now, the decline in platinum also came with a 3 drives correction and RSI divergence. So I actually would expect to see a reversal here in platinum, at least short term. Could be an actual reversal back up in platinum since we are technically at a higher low, and there's some good trading reason for that momentum to shift, at least short term, if not long term. So I remain bullish on platinum. I don't care how low it goes.
I don't
The
either.
ratio can't hold there forever. The ratio has been lower than it is currently. So for me, platinum is just probably the last minute metals opportunity. As gold and silver have started to move up, I think platinum is just the thing people are forgetting about, and I'm trying to add some to my position.
All right, well, let's not forget palladium. In terms of quarterly numbers, it was the big dog. It finished up 24%, and that sounds like palladium just keeps right on rolling, but quite honestly, it hasn't. We started the year at 1826. It had closed down towards the end of the year and gotten much weaker. We ended up seeing that as the low for the year, but it only came up to 2268 at the end of the quarter. That's still, again, 24%, but at one point we were over 3,000 because of everything that was going on with the Russian and Ukrainian conflict. So we did see a little pop there that's probably an unrealistic number, but I'm sure you had fun analyzing that from a chart standpoint and how it skewed your charts.
Yeah, a little bit. Palladium is the thing we've been expecting to start stair-stepping down, and that doesn't mean single direction. Obviously, you're going to have corrections back up, and this all goes back into the ratio discussion that we've been having for years, gold versus silver, platinum versus gold, but platinum versus its sister metals like palladium, like iridium. Palladium can go as high as it wants to. I'm still a platinum bug right now. I was a palladium bug in 2011 when it was $350, $400. Now I'm going to be a platinum bug when platinum's under 1,000.
So what are the things that have the impact on the prices? You know, we can sit here and recap a quarter, but it's always important to look ahead a little bit too. And unfortunately, there's some negative signs or indications as to what's to come. First of all, we know the Federal Reserve's planning 5 more interest rate hikes. That one's in May, is going to be the next one. Now they're talking about a 50 basis point hike, so 0.5%. We'll see what sort of impact that has. Consumer sentiment is lower than any time, even during the peak of the COVID lockdowns. And in fact, 81% of Americans polled now believe that the U.S. is going to experience a recession this year. And we talked about the inversion of the yield curve in the 2- and 10-year treasuries last week being an indication. 10 of the last 10 recessions have been predicted by that inversion. And now you've got personal finances expected to worsen to the lowest level since World War II. So be encouraged by your physical precious metals holdings.
Well, and the expectation of recession, I think, is clearly laid out in what the equities markets are doing right now. You know, first looking over at the Dow Industrials, the Industrials had 3 consecutive lower highs, 3 consecutive lower lows. We've pushed below the 200-day moving average. We mentioned this line in the sand last week. It seemed like we had a floor somewhere within a couple hundred points of 33.5, and we had pushed below it after our recording last week. Now we've had a reversal back up, probably caused by the RSI divergence you can see on the chart. Probably caused by the RSI divergence we see on the chart here, but it does look like it's starting to roll over again and continue the lower highs. So I actually wouldn't be surprised if we see one of two things happen here over the next couple days as the equities try to push lower. Either we're going to have a significant wake up early morning New York market open gap up, which is very clearly Fed intervention, or we're going to have a significant move down, maybe to the tune of 500 points in a single day, 1,000 points in a single day. I think we're going to see one of those two things happen, either the Fed stepping in and picking up the slack, or the market's going to naturally roll over as it continues to push below the moving averages and continues this trend downwards on the heels of the very important fundamental points that we're just pointing out.
Well, that's a big either or. Keep in mind, too, that the Federal Reserve tapered and they have stopped adding to their balance sheet. So if they were to come to the rescue, they would once again be adding to it when they've promised to stop. Now imagine what happens when the Federal Reserve actually starts to shrink its balance sheet. It's one thing to stop adding to its balance sheet. It's another thing to shrink it altogether, and the detrimental effect that would have on the markets would point more towards the 500 to 1,000 point drop that you say is a potential outcome.
Well, and you see this even more so in the Dow transports, which is not surprising because of oil costs going up, plastic costs going up. The transports did kind of win the I Tried award over the past week. There was a gap formed back in November that it did close, but then immediately broke down, and we're actually down about 13% in the Dow transports in a week. Significant decline in the transports.
Which again points to that concern for recession.
Right.
Another indicator.
And the transports have been so hot since March 2020 that we're still above the 382 moving average. So we've got a long way to go down for any type of actual corrective measure. I mean, a break below the 14,000 mark, which is right around where your 382 average is, could be catastrophic, and it's going to yank the industrials down with it. But it's not unsurprising in the transports, which tend to be more volatile, to have these bigger moves than the industrials do. The 2009 market break destroyed all the gains going back to 1996. The 2020 decline destroyed all the gains going back to 2016, and it stopped about 1,000 points shy of getting all the way to the 2008 highs. So it's not unreasonable to assume, let's say, a decline to around 11.5, which puts us back around like the 2018, 2019 highs, and that's right at your 618 fib. Something like that could be bullish. That could just be a bullish correction. So what does a bearish correction look like? It could be significant. And with the expectation of these fundamental reasons, interest rates, consumer sentiment, spending, availability, cash availability, investment options within your equities positions, with all of that investment money having to get redirected towards consumer staples like food and gasoline, I think the equities market is in for a very bumpy ride, and I think an 81% of Americans expecting recession this year is not an unreasonable assumption. And with these massive declines in the equities market and precious metals holding relatively stable this week, lo and behold, the dollar's breaking out to the upside. People are getting liquid. People are looking for their preliminary safety positions. Well, what ends up happening when the equities are down and the US dollar begins to decline because it's just a short-term safety hedge? People look at things like precious metals. So we are going to see this all start to play out. Equities continue to fall, the dollar rises, the dollar reverses and continues its bearish trend. Where are people going to go? The same place they did in 2009. They're going to go into hard assets and gold.
Yep. Well, that's going to do it for this week. We appreciate you joining us, listening once again.
If you liked what you heard, hit the subscribe button, ring the bell. If you'd like to learn more, you can find us on our website at McIlvaney.com. We're on Twitter at ICA Gold or Facebook at McIlvaney Financial. And as always, if you'd like to discuss your personal portfolio, we can be reached at 800-525-9556. Thanks for listening. Have a great week.